We're live on YouTube, and you're officially here for the JWB Not Your Average Investor Show. The JWB is your property of the week. I'm your host, Pablo Gonzalez. With me, as always, the gentleman that I like to call GC because of his genius concepts, because he knows how to generate cash flows, because he's a great co-host, because he's a galloping cheetah down the hallway, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And unfortunately today, unfortunate for us, fortunate for her, our phenomenal community manager, Madison, is on vacation.
Yeah.
I hope that she's having a great time.
She's out in Hawaii having a blast. So let's wish her well.
That is cool. That is very, very cool. But I want to welcome the community, and I want to welcome you if you're watching on YouTube, if you're listening on the podcast. Man, just really appreciate it. We really appreciate how the numbers have grown on YouTube and the podcast. You're clearly sharing it with your friends. And you know what else you're doing? You're going to NYAIS.com and joining us live because our community is growing live here on the show. We have brand new standards for what the average audience is out here. And I freaking love it.
Me too, man.
Yeah. So if you haven't done so yet, do it. Throw it on the calendar. Show up live one of these days. It's a good time. And it always starts with one thing. GC, do you know what that one thing is?
We'll go with the roll call, baby.
We got our leadoff batter, John Hannon, kicking us off today, as is tradition.
Thank you.
With a good afternoon. I forgot that I have to prompt you for who it is. We got Joe Bussey in the house. Joe doesn't have a nickname yet, but he's becoming a regular.
We'll work on that, Joe. If you have a suggestion, let us know. We're always open to suggestions.
We got Big Papa in the house. We love it when he calls it Big Papa. Jay Cohen. Oh, who's that? Who's that?
Big Papa, baby. That's my dad.
It's your daddy.
That's my dad hanging out.
Jay Cohen in the house. Throw your hands in the air if he's a true player. We got the ringmaster,
Andrew Barnhill.
Drew Barnhill in the house. We got our favorite fiduciary financial advisor,
Miss Kelly Barenbaum.
Miss Kelly Barenbaum. Kelly, Greg was just raving about your show this morning on our run.
I love the show.
It was good.
On Tuesday. You did an amazing job, Kelly. Thank you.
We got Greg number one, the better Greg in the house.
That's Greg Stone.
So from New Jersey, we got the early bird in the house.
Mr. Dean Curry.
We got the MVP in the house.
None other than Lee Bishop.
We got the first family, the patriarch and matriarch in the house, Ken and Carolyn Moline.
We salute
you. We got Leo Faraganan.
Dun, dun, no, no, no.
Faraganan.
Dun, 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 dun.
Leo Faraganan from Sunny Bay area. Let's rock, baby. We got Nadeem Shah with his trademark good morning, good afternoon from sunny Palm Springs.
Ooh, that's seems nice and sunny and positive over there.
You've been there.
Nadeem's always positive.
He is always. We got our favorite name to pronounce, Aaron O'Neill.
Into the lights.
Good to have you. We got the real estate maven from the mountains of Colorado.
Leslie Wilson.
Leslie Wilson in the house. Greetings from Denver. Who else we got in here checking in? We got Michael Santorios.
Oh, no. The key referral partner. That's when I think of Michael Santorios, I think of referrals. He has referred so many wonderful clients to us. Michael, thank you so much for that.
The referral machine, the Santorminator. We got Mark Mills in the house. Welcome back, Mark. Big Papa saying throw your hands in the air if you're a real player. I love it. I love it, Big Papa. We got JC in the house checking in. Good morning. Who else we got in here? Laura Colby. I think Laura checked in recently, but
yeah,
pretty new to the community.
It's not a new name. Let's not go new name.
Not a new name,
but like newish. We appreciate you being here, Laura.
Good to have you. All right. That is the roll call today. I love this. And after the roll call, we go to my favorite segment of the week, which is Madison Shares Good News. But Madison's not here, but she is still sharing good news via proxy.
She is via proxy. I'm going to do my best Madison Shares Good News impression. And we're going to be talking about this wonderful thing that we have coming up on May 1st, which is the JWB Charity Golf Tournament. Many of you, almost all of you in the community, help to support the mission of JWB Cares as we build a brand new construction home and donate that home to a veteran. And guess what? The donation day is coming up. So on Monday, May 1st, we're going to have our charity golf tournament. That's where we get to meet the veteran who will be receiving this home. And it is the best day of the year.
Best day of the year.
Pablo's there. He's I'm thinking maitre d', but that's not MC. MC. Thank you.
I'm the M&M.
You are the M&M, the MC. And, it's an opportunity to spend time with our entire team and entire network. Now, here's the challenge that we had for a few years when it came to the golf tournament. you know, when we're raising money for the golf tournament, it's done through sponsorships, and those sponsorships fill all the people who are playing golf. So we would have clients that would reach out to us and say, hey, I'd love to come to the golf tournament. Can I donate and buy one spot? And, you know, it just didn't really work for like single players or like, you know, folks that wanted to come and just be a part of the festivities. And we were like, you know, we really would love for those, especially those who are local, who want to be there, to be able to be there. And so this year is the first year that we came up with this way that we're hosting a cocktail hour, and it's totally open to any of you who would like to come and be a part of the day. We're looking for donations of $100 to be able to be a part of it so we can continue to build more and more homes. It's drinks and food and hanging out and camaraderie and all that good stuff. And it's open to all of you. So we are raising or selling those tickets through the 25th. What's today? The 20th?
The 20th,
Yeah,
April 20th.
So we're doing it through the 25th.
5 more days.
5 more days.
Mhm.
And yeah, I know the Filsons are already going to be there. They're going to be there as well.
We'll be in the house.
So it's going to be incredible. I would love to meet more and more of you, especially if you're local here and would like to come to the golf tournament. It's at Glen Kernan Country Club. All the details are on our site, which is jwbrealestate.com/fun. jwbrealestate.com/fun. You're going to come and hang out with us, have a lot of fun. The cocktail hour is going to start after golf ends. So plan somewhere around, I don't know, early afternoon. It's still a little bit of a moving target.
2, 3 o'clock, something like 2-ish.
2, 3 o'clock.
2-ish.
Yeah. We'll get you those final details.
Yeah.
And of course, all proceeds from this go 100% to JWB Cares, so that we can continue to do this great work of building homes and giving it to those who need a helping hand.
I love that they're opening it up, right? Because I'm usually there as the golfers are coming in. It's a good time. Some are there a little sauced, right? Like you're out there on the golf tournament. You've been a good time. There's a jovial affair. There's a raffle. It's like the food is great. That country club is awesome. So super, super pumped that you're opening it up. If you want to meet the Godmother family, the Filsons, will be in the Phil's house. We'll be out there. So, and of course, donate to a great cause.
100%.
Right. When the veteran, you know, when you donate that home to the veteran, man, it's the best.
It changes your life to be a part of something like that. So
yeah, it's transformative.
And you all are. So thank you again.
And I'm surprised that you're able to get that domain, jwbrealestate.com/fun. How was that not taken already?
I mean, it's incredible.
Incredible.
Yeah.
Incredible. GC, you know what I like to call that?
What's that?
I like to call that good news. Good stuff, man. Also good news. The man that everybody knows is in the house.
Noah Randari.
Noah Randari is in the house. And Joe Bussy did me a solid.
Okay.
He's got a nickname.
All right.
JWB Kenobi.
JWB. I love it. All right. Add that to the roll call, baby.
Add that to the roll call, Joe. All right. Now, just I may forget it once or something like that, but I'll get it down. JWB.
I'll be able to call you out if you don't make fun of you. So there you go.
That is, we keep each other accountable out here. So all right, man. So as we go over here to the property, then we got some breaking news. GC, what's the breaking news?
More and more good news. This is kind of like an extension of Madison Shares good news with a little bit of breaking news sprinkled on there.
Madison, watch out for your job.
Yeah. So the JWB won a really cool award that I know you're really fired up about. I know Whitney Ritchie and Rich Ritchie are very fired up about. I know Sergio Prieto from our community is very fired up about. It's called the Gator 100 Award. And this award recognizes the 100 fastest growing Gator-led companies in the world. And JWB was and is honored to receive this award, not just for one company, though. JWB Real Estate Capital, we won it for 2. We won it for JWB Real Estate Capital and JWB Property Management. This award has been going on for 9 years. This is the 6th time that we've been able to win the award. And this is the 2nd consecutive year that we've won it for 2 companies. So hope you guys are okay with me doing a little bit of just kind of bragging on my team right now, but it's a special award for us. It means a lot because, you know, we love being Florida Gators as well. And, you know, super, super fun to kind of share it with the team and with all of you. So it was a good day.
I'm so jealous of that award.
It's a good one.
You got 2 of them, GC.
You'll be there, man.
You'll
be there. You'll be there. You'll be there.
All right. I'll be there. I'll be there one of these days. Gator 100, right? UF, our alma mater. Sergio Prieto's alma mater as well. Widely known as the Harvard of Florida. Widely known. You know, it is the envy of everybody that's gone to school in Tallahassee or Miami.
I mean, the envy of beyond Florida, right? It's the envy of it's the world, right?
Yeah, it is. Yeah, some
I
people
mean,
call
Harvard calls themselves the Florida
They
of
should.
the world. I mean, let's be honest.
Yeah, and the Gator 100 is this like super prestigious, very Drew Barnwell has a bone to pick with that statement that I just said. You know, it's a wide alumni network. It's tightly knit. You know, when I lived in Southern California, it became very obvious how special it is to be part of that alumni group. The further you get from Florida, the more you appreciate it.
True.
And you know, the 100 fastest growing companies started by graduates, and you got 2 of them. It's pretty cool, man.
We're excited. We're very proud.
Cool.
So thank you guys.
Yeah. So technically you have 3 founders that are Gator grads. So I guess 2 of you.
Well, all 4 of us.
Eisman's also?
Yeah.
Okay. So how do you guys split it up between the 4 of you guys? Do
arm wrestling.
All right. Say no more. I think it's time to magically whisk ourselves away to, hold on. Let me share a screen real quick. 8039 Vining Street, Jacksonville, Florida, 32210. It has a purchase price of $250,000. It has a monthly rent of $1,506. It's a 3-bedroom, 2-bathroom, 1,209 square foot. It has been, is this a new construction, GC?
This is.
Oh, we haven't had a new construction in a while.
How about that, huh?
Yeah, I guess they're popping up again. We got a new construction in the house. Average duration of resident stay of 4.5 years, which we all know it is so crucial to delivering on your returns. Best in class annual appreciation rate that you get here in Jacksonville, where you really build the bulk of your wealth of 4.6%. And, you know, what not your average investors really care about is this estimated total IRR over 10 years of 12.4%. GC, what do you love about this property?
I thought you'd never ask, but I'll tell you what I love about this property. You know, number one, we're always going to focus on IRR, the ability to earn 12% on your money without taking outsized risk in this investing world right now is something that you should be paying attention to. Usually, if you want to go into other assets in order to earn, call it 10% or above returns right now, you got to take a lot of risk, right? Buying individual stocks because your friend gave you a stock tip, you know, on one company and hopefully that goes up. I mean, those are the type of decisions that you typically have to make right now in an investing world like we're in. So to be able to deliver 12% returns year over year, which is what this investment will be able to do, and not take outsized risk is a very big opportunity, and one I want you to pay attention to. Beyond that, though, this is new construction. And as we talk about often on the show, I love new construction properties. I also love renovated properties. And I'm going to talk about the benefits of each of those on subsequent weeks, right? Now we're going to rotate into new construction here. And new construction is a wonderful way, of course, to be able to deliver those returns. Specifically about this property, this is on sort of the lower end of the price point for new construction these days, right? You know, your typical new construction property is probably somewhere around $250,000 to getting closer to $300,000. So one of the challenges with new construction is that it is a higher price point than a renovated home. So when we have a new construction property that is near the lower end of the pricing scale, that allows many of you who are just, this is your first investment and you've been building up enough capital to get into that first one, this might be a great one for you. If you're a little bit more seasoned or you're bringing a significant amount of capital over from the stock market and you're putting it into your rental property portfolio, finding assets that are a little bit lower in price might allow you to diversify among 3 assets rather than just 2 assets. So anytime that price can be a little bit lower, that helps, of course, overcome that challenge. And that's one thing to pay attention to. The other thing here is that it's already rented. It's hard. Again, we're going to that point of not taking outside risk, right? When you already have an asset that is already rented and the residents have signed a 2-year lease on it, that is consistency, stability, positive cash flow from day one. And I really love investments that do that. So that's what I got for you here on Vining Street.
A lot to love, man. Already rented, risk mitigated, brand new construction that people like to, you know, people like the new construction out here.
They do.
And this lower purchase price. And according to Leslie Wilson, one of her favorite floor plans.
There you go. It's one that we do often.
Do you see this lower purchase price of $250,000? Why is that? Why is it such an affordable new construction home?
Well, a couple of things. I mean, we're always in the same neighborhood. So there's not too much of a variability of pricing, right? If we say it's typically 250 to 300, then it's not so much of a wide range. But how do you typically get to the lower end of that price range? Smaller homes, right? 1,209 square feet. That's a very normal floor plan for us. Like Leslie was just speaking about, it's her favorite floor plan. That's normal for us. Our square footages might go up to about maybe 1,600. So if the same home had a 1,600 square foot floor plan, it'd probably be closer to, call it $280,000 or $300,000. So that's really how you get to the lower priced.
Got it. Okay, cool. I mean, I asked that because one of our community members that we so love very much, all the way from France, Anonymous Attendee,
Love our French attendees.
we asks, hi, seeing a lot of drops in property prices in Jacksonville. Can you please address that? Thank you.
Absolutely. We are not seeing drops in property prices. In fact, prices are continuing to rise month over month. The media is saying that home values are going down or are about to go down, but that's not what the data is showing. In fact, I was just looking at our most recent market metrics report, and I don't have the data exactly in front of me, but I'm going to report on that on our next Thursday show, is give you guys a real update, exactly what months of inventory are, exactly what pricing is doing, because I think it'll open up some eyes and it will be contrary to what the media is saying, but home prices are not dropping in Jacksonville right now.
Okay. I mean, I'm a little shocked, Greg, that you directly answered a question.
How did I do?
You did great. High five, buddy. So long story short here, but we just gave a presentation to a group of doctors on Tuesday. And Greg, I don't know if you have noticed this, but when you ask him something that he doesn't necessarily disagree with, he will talk for a really, really long time without disagreeing with you. And I was like, Greg, it feels kind of disingenuous to people. Like if you won't disagree with somebody that you disagree with. So I would love it if on the show you were more direct. And that's the most direct I've ever seen from you, buddy. I'm proud of you.
You know, I just like blacked out for a second. I don't know what that was. I'll go back to being superfluous and just agreeing both. So
you are super duperfluous. All right. So that being said, we know that Anonymous Attendee is not coming out here on purpose trying to confuse it.
Yeah, of course.
Why would they have received that? You said that the media is saying that the media is saying that. Where would they get that from?
So what we've had for the last these 8 months is we've had prices that go down month over month over month over month. And the media is reporting that as the home prices are declining or dropping or crashing or whatever. The media lacks perspective, because if you go back, and of course we did this on our most recent quarterly update for all of you here, for those who attended, you were a part of this. I went back and I looked over the last 20 years and I said, from June to January of the following year, do home prices tend to go down month over month over month over month over month? And the answer is yes. Almost every single year for the last 20 years, home prices go down from June to the following January. It's called seasonality, and it happens every year. And so while the media is reporting that home values are crashing or on their way to crashing, what we were able to look at is the objective data that shows that that's very normal. In the fall and winter months, there is less demand for housing. So home prices soften every single year. That doesn't mean that the market is declining, because on average, over the last 20 years, home values have risen, including those seasonal declines. Home values have risen over 5% on average in Jacksonville. So what also happens is now home prices are going to go up month over month over month over month. If you're looking at home prices and analyzing it on a monthly, month over month over month perspective, you're missing the boat. You're going to draw incomplete conclusions. That's why the way that you analyze home price appreciation in a seasonal asset like home buying is you look year over year. And when you look at the year over year data, home values are not declining, right? Now they may decline month over year, 1 month, right? That's okay. It doesn't mean that every month they go up, but what it means is that if home values are going down month over month over month, that does not mean overall that home values are declining. You need to look year over year. And if you see year over year data and you report on that month over month, meaning March of 2022, what was the price in March of 2023? Was that higher or lower? And then you see that same thing in April of 22, April of 23. Was that home value higher or lower? That would be actual declines of pricing. That's the right way to do it. And the only way to do it until now. The media is just getting involved in actually looking at housing pricing month over month. They just really don't have the perspective.
Got it. So I'm hearing you correctly. Anonymous likely heard this based on data that was probably a couple months old, right? Because right now, if it went down in January till now, it's probably gone up month over month. And beyond that, it hasn't been looking at it year over year.
Well, it's interesting. So I don't know what it is month over month right now.
Yeah.
But here's what I think is going to happen. Because I always like to tell you what I think is what you're going to be reading in the news.
You've gotten real good at predicting headlines.
Here's the next thing you're going to be reading in the news and on the media. The news is going to say home prices are going up month over month over month. What about the crash? They're going to say home values are going up. They're, why isn't the real estate market crashing? Or they're going to take a different tune. It won't be as aggressive and positive for real estate as it was negative last year, but they're going to be looking at month over month increases. And the same methodology plays there. Just because you see month over month increases coming from March to April, April to May, May to June, does not mean that the real estate market is on fire. It just means that's seasonality working the opposite way. So my thought is you're going to start to read articles now that say home values have actually increased because they're looking month over month. But that's not really accurate either. You need to look last year versus this year and see, have home values gone up? Does that make sense?
Yeah. So what are you predicting the headline is going to be?
It's going to say
housing market is back or housing market is overheated again.
No. There's a double standard when it comes to evaluating the real estate investment versus other assets. So I don't think they're going to say housing is back, but I think they're going to say home prices increase month over month. Why is this happening? Because they're still going to think that there should be a crash. But
okay. That's the second thing you answered directly and no. So I appreciate that. Man.
2 for 2.
It's incredible. All right. Zach Foster has a really good question here. Zach is asking, how does this cash flow at 0.6% rent? Estimated 0.685% loan rate, 25% down, 7% management fees plus reserve, insurance tax. I see negative cash flow, negative 4.8 cash on cash year one at around negative $289 per month.
Yeah. I mean, do you want to go to the evaluation? We kind of walk through
the evaluation.
I love this question. Is Zach Foster?
Zach Foster.
Thanks so much for the question. So Zach, all of these investments have a more detailed pro forma that we don't share necessarily on the show, but they're all available if you go to jwbinventory.com.
And I put it in the chat.
There you go. And then you can download this exact thing. If you're a client, you're familiar with this, or if you're going through the onboarding process with this, with us, you'll be very familiar here.
The exact thing.
The exact thing.
Because it's Zach.
I got you.
You get it?
I got you.
All right. Cool.
Well done. Well done. All right.
What am I doing?
Well, let's go zoom in exactly to Zach's answer that he's looking for here. Go to expenses there, which is row 22 through, row 33. There we go. Gosh, you're like a maestro over there. All right. So this is how cash flows are calculated. Some of the assumptions that you have, Zach, that I'm looking at here with your interest rate, they're a little bit different than what you would be able to get with a JWB investment. For example, I think you had a 6.85% interest rate. This evaluation is built off of a 6% interest rate, which you 100% will get with a JWB investment. So there's a little bit of a change there. But again, if we go back to that expenses line there, your expenses are calculated through your mortgage payment, your property taxes, your homeowner's insurance, your maintenance and vacancy cost, your tenant placement, and your lease renewal fees. We're also including tax savings because that hits your bottom line. It hits your cash flow because that's money that you don't have to spend that you otherwise would in another investment. It also includes your HOA, which would be your homeowners association, as well as your property management fees. And so what we do is we take that and we look at the average cash flow over a 10-year hold, average cash flows. The thought here is this is not just about cash flows day one. This is about cash flows over a 10-year hold because cash flows grow and grow and grow. And many of your expenses actually stay flat, especially when it comes to your mortgage payment. So we look at those cash flows and then we take the average of your cash flows over a 10-year period. And that is how this produces positive cash flow. If you want to go all the way up to the top of the eval and to the right, you'll see it's probably like $200 or something. Average cash. There we go. Average monthly cash flow of 248. So that's just taking the sum of those years of the cash flows, which are positive year over year over year, and then taking the average of those on a monthly basis. And that's how this would cash flow.
There you go. Kelly's asking how you're getting a 6% interest rate without the incentives.
Great question, Kelly. In fact, we can stay right here and just zoom in right where you are, right there. So Kelly, you're right that right now, because of the mortgage market right now, a lot of that has to do with the Fed. Interest rates are higher than 6%, but JWB is doing what we believe is the right thing to help our clients at this time. And so we're giving an incentive. We're giving a concession that in the event that you cannot get a 6% interest rate, JWB is going to buy that rate down for you. And so that's where that seller concession of $5,000 is on this evaluation. We just do that. And this is a unique thing. It's not something that's normal, but you know what? These aren't normal times when it comes to interest rates as well. And so that was more of a long way of giving the answer. But at the end of the day, we're paying the bill for you to get you down to 6%.
Got it. I think it also...
For 3. 2 for 3.
2 for 3.
Yeah.
I also think it bears saying that this is a 30% down payment.
This is 30%.
Because he had made a 25% assumption.
There's usually not much of a difference between putting 25% down or 30% down when it comes to your interest rate. Really not much of a difference there.
Okay. Oh, I just meant in Zach's assumptions of positive cash flow. Do we try it at 25% and see what it looks like?
There you go.
So at 25%, average monthly cash flow comes out to 173. Okay.
And you can also look, if you go down again to just the year 2. This is what I tell people to focus on, right? Like year 2. Well, I tell people to focus on a lot of things, right? But this is also something that you want to just check out, right? Go to column G, row 43. It says 1,044. Yeah, right there. Like this is your annual cash flow in, cash flow out statement. So as an investor, I'm thinking, okay, I'm putting money out. How much am I getting back year over year over year? And that's what creates your internal rate of return. Well, the second year is really your first normal year in owning a rental property. In year 1, it's not a normal year because you have a tenant placement fee to pay, which is a cost, but you also generally don't have much maintenance or vacancy cost as well. So it's not normal. Second year is normal. You have full maintenance and vacancy that we expect, and you don't have the tenant placement fee. So look at that row there, row 43, column G right there. It's 1,044 would be your net cash flow in. Make sure that's positive, right? Make sure that's positive. And then of course it's growing over time. So on average, this cash flow for this asset, it's about $250 a month, assuming you're putting 30% down.
Okay, there you go.
And it's a little bit less if you're putting 25% down, just because you are borrowing more money. You have more of an interest, more of a mortgage cost.
There you go. So there's the answer. I hope that was exact enough for you.
Well
There's an epic battle happening in the chat right now because our favorite financial fiduciary nerd found here an article that says that UF is considered a public Ivy on some lists by an expert, publicivy.com. Drew's having a really hard time internalizing this. And one of your teammates, Max, is also having a real hard time internalizing it. But, the facts don't lie. It says it on the internet. We're on a list.
They're such savvy individuals. Drew and Max, they're just incredible people, just misguided on a couple things. I mean, I don't want to hold it against them.
It's real unfortunate. It's real unfortunate. GC, I got another test for you. If real estate investing, if these rental properties are such a good investment, why are you offering these to the public? Why don't you just buy all of these yourself?
Well, that's a great question. I'll tell you that, I love this asset class so much. I love this asset class. When I saw the potential of it, I said, I'm going to quit my corporate job and I'm going to go full steam into buying rental properties. So I built up a portfolio for myself. In addition, I saw an opportunity to build a business, which would involve selling that asset to other people as well. And I don't think those two things need to be mutually exclusive. So I appreciate the question. Pablo and I actually got this question when we were just speaking to our friends at the St. Johns County Medical Society the other day. And, what I said was, I don't think they need to be mutually exclusive. I think it's a great question to ask. If anybody is selling you a financial instrument, you should ask them, do they also invest in it?
Are you in it too?
Yeah. So I am definitely in it. I own over 300 of these things. I think that's a good, healthy place for me to be. And, the ability to sell these properties helps us have more of an impact, right? Help us have over 1,300 clients that we get to help, form their financial portfolios, create 100 jobs here, just internally, thousands of jobs beyond that. So yeah, I feel pretty good about that decision about selling them.
Yeah. On the drive home, right? Like letting you a little peek behind the curtain. I was like, man, you really fumbled that question. Why don't you just tell him, because I already bought 300, a wise investor diversifies. And guess what? Right now I'm buying 19 city blocks of downtown Jacksonville because I'm so in love with this asset class. I couldn't help but not hear you say that.
Still struggle with going strong with that. I do. I don't know. It's important for you all to know how much we are investing in downtown Jacksonville, because I think it's a very big reason why you want to invest with us. But I don't know if I can do that, without having to toot my own horn. I much prefer that.
Yeah, I like to be obnoxious on your behalf.
Yeah.
All right. So back to this property though, GC. Can't help but notice, right? The incentive is gone. Still getting a 12.4% in this economy. 12.4%, man. I love this little data point. JWB clients have earned 79% more home price appreciation than the average Jacksonville investor. Just talk to me about this whole idea of this 12.4% in this economy. Just seems pretty rare. Like we just went over the whole like Jamie Dimon thing. And I just think it's a good time to just repeat this whole like equity into income. Capital preservation, beating inflation.
Yeah.
Right.
Those three things play, right? You're going into a tumultuous time. It's been a tumultuous time as an investor, but it's, we're not in a recession yet.
Yeah.
And what Jamie Dimon was talking about is he's like, I don't know exactly if this is going to be as deep as it could have been when it comes to a recession. I don't know if there's going to be a recession. I don't know if it's going to be a mild recession. But what I know is that there is going to be a lot of variability because things are unstable right now from the financial perspective from our country. When you think about the amount of stimulus that is, put into our economy, when you think about the amount of participatory action that the Fed has taken by buying bonds and mortgage-backed security. They're an active participant in our economy. They basically print money or have printed money and injected that directly into the economy by doing that. And, a number of other things. We're still dealing with supply chain issues. I know that because I build houses for a living. You've got the war in Ukraine. You've got so many geopolitical things that are just, it is a highly variable time. And so, there are assets that do not do well during those times. And then there are assets that do. And stock market is not an asset that does well in recessions. It's not an asset that does well in times of large variability, geopolitical variability as well. The average loss in recessions since World War II is 30%. The average loss is 30% during recessions. And that's of the S&P 500. And not every recession had as much variability as we have right now.
Was it the average loss is 30%, or was the average in like the 7 biggest recessions? I forgot. Is that the data study that
we're kind of saying the same thing?
Yeah.
It's what I'm quoting is from all the recessions since World War II.
Since World War II.
Yeah.
Okay.
Yeah. So, that's not looking good. So then bonds on the other side, so, it's all relative. Now people are saying, oh man, bonds are a great investment, right? I'm earning 3.5% or 4% on bonds, or maybe a little bit more if it's corporate bonds or whatever. And they're like, oh man, that's great. And people are looking at their CDs and they're looking at like their interest rates they can get in their savings accounts. And they're like, oh man, this is great, but it's not great. You know why? Because inflation is still 5%, and core inflation, which is even more important when it comes to actually understanding how long inflation is going to last. Core inflation is still 5.6%. So when you're earning 4% on something and costs are rising at 5%, you're losing. So bonds are not a solution for folks right now.
Yeah.
Equities in the stock market, we just talked about, not a solution. It's really hard to find assets that you can beat inflation, where you can be defensive, where you can focus on capital preservation because they're consistent, and you can turn equities into income. That just means creating positive cash flow. And that's why I love this asset. I love this asset for you. I love this asset for me. I love the 3 that you own. Like, that's why this is a solution to really help people in a very tough time to invest.
Makes sense to me, buddy. I'm glad we got to hit on that again. We've got not your average guest. So you're putting it in the Q&A. If you tapped in from your text, from the text reminder, you show up as not your average guest. So I don't know exactly who this is, but I'm assuming it's one of our community members who I should know, saying, hey, Gregg and Pablo, I call that skin in the game, right? Like you talking about owning 3. Any comments on the Blackstone financial issues and will it affect the rental market? Thanks, guys. Are you up on that stuff, man?
Honestly, I'm not up on it. It's been a crazy week just for me getting back from spring break vacation with my family. And then we did that dinner. So I'm not up on that.
I'm not super up on it either. Maybe we do a Not Your Average Insights when I get back from Louisville. But all I know is from what I understand, it's this idea that Blackstone and another kind of fund have been discovered to be holding companies that actually hold by public perception, an unreasonable amount of companies that are publicly traded. They have people on the boards of too many. That's the public opinion that now has these riots happening in Paris inside their headquarters. People are rioting and, add that to the fact that France just raised the retirement income by a certain amount and people are crying foul and they're crying foul. So yeah, something like that. Oh, okay. It's Eddie from Hotlanta that checked in. Thanks, Eddie. Okay. So I'm not 100% sure. I think we can dive into this thing, not your average investor style. And
Drew says it's all about commercial real estate mostly. So maybe having something to do with that as well.
Yeah,
so.
I might be completely wrong. Right? Yeah. I know that there's riots happening and there's insider stuff. And
great questions.
Yeah.
I think it's awesome. We'll definitely come back to you guys and I'll give you my take on it.
I would like to highlight that Jen Filzen shared something with us. She shared breaking news. I don't know if anybody that hasn't been following along, Jen, fairy godmother of our community, her dear grandmother passed away. They have a property here in Florida. Jen was kicking the tires on investing in it, and she decided against it, buying the house because the numbers didn't work, right? So instead, she's going to buy a JWB property and another one this year. That's pretty awesome.
That's amazing, Jen.
Yeah. But what's really cool, I mean, that is really cool. But what's really cool is that she wouldn't have been able to feel confident about the decision of whether or not of how to crunch the numbers for grandma's house. Thanks to this community, she is, and folks have helped her out, and that's really, really cool, Jen.
Jen, that is amazing. I just think about Jen and Renee's growth, right? Jen and Renee believed in us, 12 years ago now when they came on board and whatnot, and they wanted to consistently build a portfolio over time. And how you talk about how your vision is to expand your portfolio and largely refinance the properties in future years. Well, I know Jen's been living that out. So she bought a few properties in the beginning and then has really kicked it up because of the opportunities that are presented to her as far as home values going up so much the last couple of years. She didn't just sit on that equity and just let it do nothing. She was able to refinance that. She was able to pull capital out and turn that into 4th, 5th, 6th. I'm not sure which property she's on right now. So that's really incredible. And Jen, that's awesome that you were able to get the support. I know you sent an email and I know that you were asking about this, and I'm so glad that the team was able to help you out and help you come to that conclusion, which is right for you. And I'm with you on this community. I think people show up a little bit for the crazy zaniness that is me and you, but I think more and more they come for the community. We have such an incredible collection of brilliance here in the audience and
aggregated knowledge.
It's incredible. So
it's really, really cool. Thanks, Jen, for sharing that. What I hear in that story is, I think, a very likely story. It's this idea that real estate is a very emotional decision for most people, right? Like we heard it in Kelly's episode too, right? When I asked her why she did it, first she went into the emotional side before breaking down the financial side. And it's just really, really important to to separate those things when you're doing the investment side of it, right? I think for where you're going to live as a home, I think the emotion very much plays into 100%. It. It's about having a place for your kids to grow up. It's about do I love this, thing that this tree in the backyard, whatever, right? All that stuff is real.
Right.
When it comes to the investment side of it, definitely got to be able to understand the numbers on it, understand the long-term ramifications, understand what's going to make it work as an investment. So it's not just a spreadsheet, a promise that was never kept.
Right.
And I think that is what you've gotten really, really good at explaining for folks. And then the community has learned it. And now we can each help each other out with it. So take the emotion out of it as an investor. It's not a place you're going to live. It's a place that needs to work for your lifestyle and work for your wealth creation.
100%. And that's tough to do, what you're just describing there.
Yeah.
It's really tough to do, especially, you know, everybody knows that I'm an owner of JWB, so I'm clearly biased here, right? Like I have an incentive to sell houses. We all know that. So there's a special place for community, which sits between you as the investor making the decision and challenging yourself to be objective about it, which is tough. There's a place for me to be able to share with you, you know, and teach and train and share and all this good stuff. But you know that I'm biased. You know that I have an incentive to sell houses. There's a place for community, which sits right between. And that's where I think the strength of this community just is, it's such a positive influence for those. It helps people like Kelly take that step. It helps Jen take this step for herself. And I'm so thankful for all of you. I mean, hundreds of you a week take hours of your day to come and hang out and just be around this entire community. So clearly we have something special here.
And there's something special about the fairy godmother of the community getting the benefit of the community, right? Like sowing the seeds that she planted. We love you, Jen. Just throwing it out there. Can't wait to see you soon. I think that's it for us today, man.
Love it, man.
We had 50 plus people today on the show, right? Like a nice, quick in and out, 45 minutes, answer some tough questions. You actually said no to people on questions that you didn't agree with. I saved
us like 10 or 15 minutes just in my answers right there.
I think that was it. Oh, well, we got one more.
All right.
Roger Evans. I understand JWB is a business. And from what I heard in the past, they make a lot of money by managing their investor homes. For transparency, the question is, how much does JWB make on selling, let's say, this home or any other home on average?
About $20,000.
Easy peasy, baby.
How about that?
You did not add 7 minutes to this conversation.
I didn't. I am going to add one thing for context. So I think you gave me that ability to do that. We make the majority of our money in home sales, not on managing homes. And I think it should be that way too, because you're only going to come back and buy more homes from us if we do a good job for you, right? And we focus on repeat business and referrals and whatnot. So yeah, the majority of our income comes from home sales. Property management is something that we do to continue to fulfill the promises that are made on the sales side. And so yeah, there you go.
That was it, man. You did the thing. I was like, answer it directly and then justify your answer instead of like going in circles.
He can be taught.
So much growth today. It's incredible. I'm a little bit close. Oh, but yeah. Thank you, community. Thank you for being here today. Really, really great questions. I'm in Louisville next week, but I'm pretty pumped for the show that's coming up.
I'm ready, baby.
You ready?
I'm ready. I'm ready to sit in the hot seat right there.
You're going to be in the hot seat. GC is going to go at it solo. GC has recently come up with a way to help everybody understand what's wrong with only thinking about cash on cash returns, how to consider your cash on cash return, how to truly understand the way that the asset class works, and just make it very, very obvious through what we all know is the most important thing, through a mentor, right? Like, and packaging this into a story. And that story is one of the greatest American stories of all time. We're going to leave it there. Just teasing it. Just teasing it, baby.
I know.
It's going to be a great one on Tuesday. I'm sorry I won't be here. I'm definitely going to check the replay because I want to give old boy over here some pointers. I want to thank the community for coming. It never goes over my head that you just spent 45 minutes with us in the middle of a Thursday, and it makes this thing really, really awesome. It's you that make it great. GC, I'll give you some last words.
Thank you guys for being here. I do want to let you know that I can't do this alone next week. I'm going to need everybody's love and support because it kind of scares me to be doing everything that Pablo does and to try to teach this thing. So if you can show up and be ready to fill in the gaps when I'm sure I'm going to screw it up a few times, that would mean a lot to me. I'm looking forward to Tuesday. I think it's going to be a great show, and I'm looking forward to you all being there. And I hope you have fun on your trip, man.
You know, man,
I'll call you.
I'm really looking forward to it. Too soon, pal. And, you know, we joked a lot today about the supremacy of Florida as an institution here in this state, the University of Florida, but you're all welcome. Florida State grads, you're welcome here. USF grads, you're welcome here. University of Miami grads, you're welcome in this community. Wherever you went to school, you're welcome. The only thing you can't do, you just can't be average. We'll see you on the next one. See you.